In 2015, a modern European country fully connected to global markets, using the euro and sitting at the heart of the EU, came frighteningly close to complete financial collapse. Banks closed. People lined up at ATMs. Cash withdrawals were limited to just €60 a day. Pensions were frozen. And the birthplace of democracy suddenly found itself negotiating for economic survival. This wasn't ancient history, this was modern Greece. How does a developed nation, backed by strong institutions, end up on the edge of default, like a collapsing empire from centuries ago? And more importantly, why does this matter to the rest of the world? Because Greece's crisis didn't just expose one country's weakness. It revealed a hidden truth about the global financial system, how debt becomes leverage, and how quickly national control can disappear when the money stops flowing. Let's rewind. When Greece joined the Eurozone in 2001, it gained something incredibly powerful: cheap borrowing. For decades, the country had carried high debt. But inside the Eurozone, investors suddenly assumed Greek bonds were as safe as German ones. Interest rates plummeted, and Greece suddenly had access to money on a scale it had never seen before. Public spending surged. New projects were built. Salaries increased. The economy felt modern, growing, and stable. It was a golden era. But underneath the shiny surface, a deeper problem was brewing. A bloated government, weak tax collection, widespread corruption, and budgets that simply didn't balance. Then came 2008, when the global financial crisis hit. The world's financial system froze. Suddenly, investors weren't just looking for returns. They were looking for risk. They started investigating government finances more seriously. By 2009, the Greek government was forced to admit the truth. It had been underreporting its deficit for years. The real number wasn't the manageable 3% they claimed. It was nearly 15% of the country's entire economic output. Investor confidence evaporated overnight. Borrowing became impossible. The flow of cheap money stopped. Greece had run out of road and had no choice but to ask for a bailout. In 2010, Greece received a massive rescue package from the European Union and the International Monetary Fund, but bailouts always come with strings attached. And these strings were brutal. Severe austerity measures were imposed: massive spending cuts, crippling tax hikes, deep pension reductions, and radical labor reforms. On paper, these were meant to fix Greece's finances and restore confidence. In reality, they pushed the economy into a death spiral. GDP shrank year after year. Unemployment soared to over 25%. Businesses shut down. For young people, the situation was catastrophic, with youth unemployment climbing past an unbelievable 60%. An entire generation's future was put on hold. And here's the harsh truth of economics: when an economy collapses, its debt becomes heavier, not lighter. It is like trying to run a marathon with a broken leg. The finish line just gets further away. By 2012, Greece needed a second bailout and even had to partially default on its debt. But the crisis still wasn't over. The breaking point came in 2015. After 5 years of painful austerity, the Greek people had had enough. In a historic referendum, they overwhelmingly voted nitrogen monoxide to further cuts. It was a powerful act of defiance. Yet, just days later, their government, completely out of options, was forced to accept an even tougher deal. Why? Because the alternative was chaos. Exiting the euro and returning to the old currency, the drachma, would have meant immediate financial meltdown. Banks would fail, savings would be wiped out, and the country would be cut off from the world. At that moment, Greece effectively lost control of its economic policy. Decisions about its taxes, its budgets, and its spending were no longer made in Athens. They were overseen by the Troika, the EU Commission, the European Central Bank, and the IMF. There was no invasion, no soldiers in the streets. Just financial dependency, a quiet modern loss of sovereignty. But Greece's story is not unique. History is full of countries that kept their flags and their governments, but lost control over their own finances. The Ottoman Empire faced similar foreign financial oversight in the 1800s. Egypt lost its financial autonomy after heavy borrowing to build the Suez Canal. In each case, debt opened the door to foreign control. Greece simply experienced the 21st century version of this ancient pattern. The cost wasn't just economic, it was social. Pensions slashed, hospitals underfunded, a decade of progress erased. Even today, After years of recovery, Greece still carries one of the highest public debt levels in the world. The scars remain. So why does this matter to you, wherever you are in the world? Because the forces that crushed Greece are still very much alive. Today, countries like Sri Lanka, Pakistan, and Argentina are facing their own devastating debt crises. Even the world's wealthiest nations carry enormous debt burdens: Japan, Italy, and yes, even the United States. The difference isn't vulnerability. It's just a matter of scale. If market confidence disappears, even the strongest economies can feel the pressure. Greece's story is a profound warning. Debt is easy to take on when times are good. It feels like free money. But when the markets turn, lenders don't just want repayment, they want control. And when you depend on borrowed money, your choices shrink until you have no choices left. This is true for nations and it's true for individuals. Debt doesn't have to destroy you, but it always limits you. And the moment you lose control of it, someone else gains control of you. If this gave you a new perspective on how money shapes our world, hit that subscribe button. Here at Legacy of Money, we explore the financial forces that define nations and shape your future. Thanks for watching.